Do you hear that silence right now? That silence is not calm. It is the sound of a market seconds away from doing something violent. As you are listening to this, silver is trading at $65.77, not crashing, not exploding, just sitting there, flat, motionless. And that is exactly why this moment matters more than any headline you have seen all week. Because this is not boredom, this is tension. This is the final pause before a decision that will ripple through markets on Monday morning. For the past 5 days, the banks have thrown everything they had at this price: margin hikes, short contracts, coordinated pressure designed to force silver back down towards $60. And they failed. The price did not break. It did not even flinch. It held the line at $65 going into the most important moment of the entire trading week, the Friday weekly close. This is where most people get it wrong. They stare at the screen and think nothing is happening. Professionals know better. In institutional markets, the daily price is noise. The weekly close is the verdict. And if silver closes this week above $65, something mechanical happens next. Something automatic, something that does not care about news, opinions, or fear. Right now, billions of dollars in algorithmic systems are watching one number, 65. A close above it flips a switch. A switch that historically triggers forced buying on Monday. Not emotional buying, not retail buying, machine buying. That is why this quiet moment feels so heavy. That is why banks are nervous, and that is why this next close may mark the point where control quietly changes hands. Stay with me, because what happens next is not driven by hope, it is driven by rules. Most people think markets move on news. They don't. They move on timing. Right now, the clock matters more than any headline, because this is Friday, and in institutional finance, Friday is not just another day. It is the courtroom. It is where the week is judged. For years, this exact window has been used to erase breakouts and crush momentum before it becomes official. And that pattern is about to be tested again, right now. But something is different this time. For the last 5 trading days, the banks tried to break silver. Not quietly, aggressively, margin hikes, paper selling, relentless pressure designed to shove price back towards $60 before the bell. This is not a theory. This is a standard playbook. And yet, silver did not fold. It climbed. Then it stopped. And then it refused to move. That refusal is the signal. Because when price should fall and doesn't, control has already started to slip. This is where amateurs get bored and professionals lean forward. When silver sits at $65.77 and goes nowhere. It looks dead, but dead markets don't scare banks. Frozen ones do. Because a flat price after a sharp rise is not a weakness. It is absorption. Sellers are hitting the market. Buyers are swallowing every contract without letting price drop. That is not random. That is pressure building. Think of it like holding a beach ball underwater. The harder you push, the more force builds against you. At some point, arms shake, grip weakens. And when that pressure is released, the move is not gentle, it is violent. Silver is not resting, it is loading. And the people who know this are not watching the 5-minute chart. They are watching one candle, the weekly close, because the weekly close decides everything that comes next. If silver finishes this week above $65, the chart does something it has not done cleanly in years. It prints strength, not intraday strength, structural strength, the kind that machines recognize instantly. And once that happens, the market stops asking permission. That is when the rules change. Because when the week closes, humans stop trading, but the systems do not. And what those systems are programmed to do next is why this quiet moment is the most dangerous part of the entire move. And that's exactly where we're going next. Here is the part they never explain on television. For years, every time silver tried to break out, the same thing happened. Friday afternoon arrived, liquidity thinned, and suddenly, massive sell orders appeared out of nowhere. Paper silver, no metal, just contracts. Dumped fast enough to force the weekly candle to look weak. Long wick on top. Fake failure. Momentum killed before Monday even opened. It worked again and again because charts don't lie, but they can be manipulated at the close. And the weekly close is where confidence lives or dies. That was the trick, and most people never noticed it. But this week, the trick stopped working. Silver ran from $60 to $66 fast. Too fast. In the past, that kind of move would have been punished immediately. A sharp drop, panic selling, a clean reset. Instead, price stalled, it went flat, right at $65. And it stayed there. That is not normal. That is defiance. This is where frustration turns into fear for the people on the other side of the trade. Because when price refuses to fall, it means supply is no longer responding the way it should. Sellers are trying. Buyers are simply stronger. Every sell order is being absorbed, quietly, efficiently, without drama. This is what control slipping looks like. And here's the part that should make you angry. When price holds like this, it exposes the lie that most people have been fed, that market is free, that prices move naturally, that nothing is happening. Something is happening. It's just happening beneath the surface, where retail is trained not to look. While people argue online, the real fight is happening at one level, $65, because that number is not psychological. It is mechanical. Above it, the weekly chart flips from resistance to confirmation. Below it, the game resets. And the banks know exactly what that means. They know that if silver closes this week above $65, they lose their ability to shape the narrative on Monday morning. That's why the price hasn't moved. They are trying to pin it. And they are running out of leverage. This is not a theory. This is structure. In modern markets, most volume is not human. It is algorithmic. Trend-following systems, CTAs, black boxes that do not care who you are or what you believe. They follow rules. And one of those rules is brutally simple. Weekly close above resistance equals buy. No debate, no emotion, no discretion. That's why this moment feels tense. Because if the weekend's here, control doesn't shift loudly, it shifts quietly. And by the time most people notice, the buying has already started. And once those systems turn on, the market stops asking permission. Once those systems flip, the risk profile changes instantly. And here's the part almost no one prepares for. The most dangerous moment is not the breakout. It's the weekend. Traders are trained to fear weekends. Markets closed, no liquidity, no control. Headlines can drop at any moment. In normal markets, that fear makes sense. But this is not a normal market. And right now, the real risk is not holding silver. The real risk is holding cash. Because news does not respect market hours. Shortages don't pause for Saturdays. Geopolitics doesn't wait for Monday morning. And if something breaks while the market is closed, you don't get a second chance. You don't get to buy the dip. You get a gap, and gaps don't ask permission. That's why you're not seeing sales this close. People aren't calm. They're trapped. No one wants to be exposed to 48 hours of unknowns while holding paper. Because when markets reopen, they don't reopen fairly. They reopen where supply and demand collide. And right now, supply is thin. This is why silver holding $65.77 feels heavy. It's not indecision. It's avoidance. Nobody wants to be the one who is sold on Friday and wakes up on Sunday night staring at $67 on the screen. That is how careers end. That is how positions are lost forever. This is how FOMO is born. And while retail argues, another shift is already happening quietly. The narrative is changing. For years, silver was ignored, mocked, treated like a relic, a pet rock, something only crazy people talked about. Now headlines are slipping through. Silver outperforming gold, solar demand tightening supply, strategic metals, industrial pressure. This is not hype. This is permission. When the media changes tone, the public follows, slowly at first. Then all at once, financial advisors stop dismissing it, pension funds stop laughing, and retail, always late, finally notices the move when price is already uncomfortable. That's when logic disappears. Because the public doesn't care about $65. They care about direction. And once they believe something only goes up, valuation stops mattering. They don't ask how far it's come. They ask how far it could go. That's when markets stop behaving politely. And here's the part you're not supposed to say out loud. Once momentum, media, and machines align, control doesn't come back easily. You don't manage that kind of flow. You react to it. And the ones who react late pay the highest price. That's why this moment feels tense. That's why silence feels loud. And that's why this close matters more than people realize. Because what happens next is not driven by emotion, it's driven by structure. And once structure takes over, the market doesn't whisper anymore. When structure takes over, charts stop being decoration, they become confessions. Zoom out far enough and silver tells a story most people have never been shown. Not a weekly story, not a yearly story, a multi-decade one. And that's where the discomfort really begins. Because this move did not start last month. It did not start last year. It started decades ago, quietly. while everyone stops paying attention, look at the monthly chart going back to 1980. One peak near $50, then collapse, then silence. A 30-year stretch where silver was written off, forgotten, ridiculed, then another peak in 2011, again near $50. And again, disappointment. That wasn't a failure. That was construction. And most people never recognized what was forming. That shape has a name, and it doesn't form by accident, and it doesn't resolve politely. And once you see it, you can't unsee it. This is the cup and handle, one of the most powerful patterns in technical analysis. The bigger the base, the more violent the resolution. And this base took roughly 45 years to build, from the bottom near $4 in the early 2000s to the rim at $50, then years of sideways punishment to shake out anyone without conviction. That wasn't stagnation, that was filtration. And it was designed to exhaust you, which is exactly why it worked. Because patterns like this do not resolve with small moves. They resolve with measured ones. The math is simple. The depth of the cup is roughly $46. Add that to the breakout zone near $50 and you arrive at a target near $96. Not hype, not opinion, geometry. And right now, at $65, we're barely a third of the way there. That should make you uncomfortable. And that discomfort is the point. Now zoom back in. The intermediate levels matter too. Markets don't move in straight lines. They move in ratios. Fibonacci extensions, human behavior disguised as math. And the most important ratio, the golden one, projects the next major gravity zone near $72. That's not a guess. That's where machines are programmed to look. Between $65 and $72, there is very little price memory, very little resistance, very little friction, which means once price clears $65 cleanly, the market doesn't need a reason to move fast. It just needs permission. And that permission comes from the close. That's why this moment feels so tight. That's why the air feels thin. And that's why small moves suddenly turn into gaps. People will say silver is overbought. They always do. And they are always early. In strong trends, overbought doesn't mean done. It means pressure. It means velocity. It means the engine is running hot because demand refuses to cool. And history is ruthless to anyone who mistakes speed for exhaustion. Because once round numbers like $70 come into view, psychology kicks in, sellers line up, buyers absorb. And when sellers run out, the price doesn't crawl, it jumps, and jumps don't wait for permission slips. This is where most people panic, this is where most people sell too early, and this is where control is permanently lost. And now comes the hardest part of all. This is where most people lose, not on the drop, not on the spike, but in the silence after the bell. Because once the week closes, markets shut down, but your mind doesn't. And that is the real battlefield. Friday night hits, phones come out, headlines scroll, rumors spread, and suddenly a position that felt obvious an hour ago feels dangerous. That's not logic, that's design. The weekend is where doubt is manufactured, and it works frighteningly well. You will hear that silver is overextended, that it has run too far, too fast. Someone will say the move is crowded. Someone else will warn of a pullback, and all of it will sound reasonable. That's the trap. Reasonable fear is still fear, and fear is the fastest way to hand over control. Because here's the truth no one likes to admit. In moments like this, doing something feels productive, sitting feels reckless, but history punishes the busy, not the patient. And the market knows exactly how to exploit that instinct. That's why weekends are dangerous. This is when people hedge for no reason. Trim winners too early, sell just in case. And then spend Monday morning watching price run without them. That pain doesn't come from being wrong, it comes from being shaken out. And once you've been shaken out, the re-entry price is never kind. That's not an accident. That's the system doing its job. There is an old lesson from one of the greatest traders who ever lived. He didn't say the big money was made by thinking harder. He said it was made by sitting, by recognizing when the market has already chosen a direction and refusing to interfere with it. That lesson sounds simple. It isn't. It goes against everything your nervous system wants to do, especially now, because this is not a moment of hope anymore. Hope is fragile. Hope panics. What's forming here is certainty, structural certainty, the kind that doesn't need cheerleaders, the kind that doesn't flinch at headlines, the kind that survives weekends. That's why this week feels different. The price didn't break, the pattern didn't fail, the pressure didn't release. And when that happens, something shifts internally. You stop asking if the move will happen. You start asking how violent it could be. That mental shift is rare, and once it happens, it doesn't reverse easily. This is where weak hands are trained to leave, because when markets move from hope to conviction, volatility doesn't disappear. It intensifies. Dips feel sharper, headlines feel louder, and anyone without a plan starts reacting instead of observing. That's how positions are transferred from the impatient to the disciplined, quietly, efficiently, relentlessly. So if you feel uncomfortable right now, that's not a warning sign. That's confirmation. Comfort doesn't exist at inflection points. Only pressure does. And pressure always reveals who was prepared and who was just guessing. And the most important part, this story isn't finished at the close, it starts there. This is the moment after belief hardens into posture. You can feel it when a market stops reacting the way it used to. Bad news doesn't push it down. Good news doesn't make it euphoric. Price just holds. That is not balance. That is dominance quietly taking shape. When silver refuses to fall at $65.77, it is no longer negotiating. It is waiting. And waiting markets are the ones that explode without warning. That's the part they never tell you. This is not a tug of war anymore. It's a countdown. Because once the close is locked in, something irreversible happens. The weekends, books are closed, and risk is carried forward. The people who needed price lower are forced to live with that reality for 48 hours. No hedging, no fixes, no exits, just exposure. And exposure is where panic begins to grow roots. That's when Monday stops being another trading day. It becomes a reckoning. If silver opens higher, even slightly, the narrative collapses, shorts are underwater, calls are in the money, models rebalance, and the first buying wave is not aggressive. It's methodical, cold, relentless, the kind of buying that doesn't chase candles. It fills allocations. And once that starts, price movement stops being negotiable. That's when disbelief turns into urgency. And here's the part that stings the most. The people who sold to be safe don't get clarity. They get regret. Because re-entry is never gentle. When silver moves in gaps, it doesn't offer apologies. It doesn't come back to make you feel better. It moves to where supply exists. And when supply is thin, that move is violent. That's how positions are lost permanently. Not by being wrong, by hesitating once. Meanwhile, the public wakes up late. They always do. They don't hear silence, they hear price. And once price starts moving fast enough to show up on screens and social feeds, logic disappears. Fear flips direction, and instead of fearing losses, people fear being left behind. That is when markets detach from comfort. And when that happens, all the things people swore they would sell at become irrelevant, targets are ignored, anchors snap, and the same voices that warned you to be careful suddenly ask if it's too late. That shift doesn't happen at the top, it happens at the midpoint, and by the time it's obvious, the move is already mature. That's the trap of visibility. It always arrives late. So if this moment feels uncomfortable, that's because it should. Inflection points are not designed to feel safe. They are designed to test conviction, to pressure patience, to punish those who need certainty before acting. And markets never reward certainty seekers. They reward those who can sit inside ambiguity without flinching. That is the real edge, because when silence finally breaks, it won't sound like a warning. It will sound like momentum. This is where the story becomes uncomfortable for the people who thought they were in control. Because when momentum finally speaks, it doesn't ask who deserves to win. It only asks who is positioned correctly. And right now, there are players on the wrong side of this move who cannot simply walk away. They are not traders clicking buttons. They are institutions with exposure, with obligations, with risk that doesn't disappear just because the weekend is over. That's the part retail is never told. When price moves against an institution, it isn't emotional. It's procedural. Risk limits are hit, models recalculate, margin calls don't negotiate, and suddenly, buying is no longer a choice. It's a requirement. That's how a pressure turns into fuel. And fuel doesn't care about your opinion. This is why control doesn't vanish all at once. It erodes quietly. Then suddenly, at first, price holds, then it lifts. Just enough to make denial uncomfortable. Shorts tell themselves it's temporary, that it will fade, that it always does. But this time, it doesn't. Liquidity thins, offers disappear, and every attempt to push price back down costs more than the last. That's when panic changes shape. It doesn't look like chaos at first. It looks like professionalism, calm buying, controlled covering, but beneath that calm is urgency. Because every tick higher tightens the vice. And once the market senses that urgency, It stops offering mercy. This is how squeezes actually start. Not with fireworks, with silence breaking. And while that's happening, the people who were told to be patient are suddenly told to act fast. That whiplash is not accidental. It's how power transfers hands, from those who assumed they could manage price to those who simply held through discomfort. That's the injustice most people feel but can't articulate. For years, silver was suppressed, dismissed, ignored. And now, the same voices that mocked it will scramble to explain it, to rationalize it, to claim they saw it coming. But explanations always arrive after price, never before. And by then, the opportunity has already changed shape. This is when narratives chase charts. And once that happens, the market becomes unforgiving. Late buyers don't get perfect entries. Late sellers don't get forgiveness rallies. Everything speeds up. Emotions intensify. And the same people who laughed at $65 start panicking about $70. That shift is violent because once disbelief breaks, fear doesn't vanish. It flips direction. And fear of loss becomes fear of missing out. That is when discipline collapses. That is when rules are abandoned. And that is when markets overshoot in ways that feel irrational but are perfectly human. This is not chaos. It's psychology catching up. And here's the final truth. The people who survive moments like this are not the smartest. They are not the fastest. They are the ones who recognized what was happening before it became obvious. The ones who didn't need confirmation because they understood structure. Because by the time confirmation arrives, the move is already punishing. And what comes next is where everything accelerates. This is the phase where the truth stops being optional, because once momentum accelerates, denial becomes expensive. The market stops rewarding hesitation and starts punishing disbelief. And the people who spent years dismissing silver are suddenly forced to explain why it refuses to behave the way it should. That's when confidence cracks. Not quietly, publicly. You can see it in the questions. Why isn't it pulling back? Why didn't it fade? Why does every dip get bought? Those are not analytical questions. They are symptoms, and they signal something deeper is breaking. This is when the story changes from price action to credibility. Analysts hedge their language. Commentators soften their tone. The same outlets that ignored the move begin covering it cautiously, then urgently. Not because they understand it, but because they can no longer ignore it. That's how legitimacy is granted, late, reluctantly, and only after price forces the issue. And once that happens, a new group enters the market. Not traders, not speculators, allocators, advisors, institutions that don't chase charts, but also don't like being wrong in public. They don't need a perfect entry, they need exposure. And when they move, they don't nibble, they position. That's when volume changes character. Moves get sharper, pullbacks get shallower, and volatility doesn't mean weakness anymore. It means urgency. Every pause becomes shorter. Every rally becomes harder to fade. And suddenly, the idea of waiting for confirmation feels absurd. Because confirmation is everywhere now. This is when the public finally arrives. Always late. Always emotional. They don't hear about structure or weekly closes. They hear about price. They see screenshots. They see numbers they didn't expect. And once they believe the move is real, they don't care where it started. They only care where it might end. That's when rational thought leaves the room. Fear flips direction. Instead of fearing losses, people fear being left out. Instead of asking if something is expensive, they ask if it's too late. And that single question changes everything, because markets don't top on skepticism. They top on euphoria. And euphoria doesn't announce itself politely. It sneaks in disguise as confidence. This is why moments like this feel unfair, because by the time the crowd agrees with you, the easy part is already over. The patience, the boredom, the silence. That was the price of admission, and most people refuse to pay it. That's not coincidence, that's designed. Because markets are not built to reward consensus. They are built to transfer wealth from the impatient to the disciplined, from the reactive to the prepared. And once that transfer begins, it doesn't reverse cleanly. It accelerates, and now with momentum awake and narrative scrambling. The final question isn't if this move continues. It's how people behave when it does. Because behavior, not charts, determines who survives what comes next. And what comes next is where everything gets louder. So here's the bottom line. This entire story comes down to one thing: control. And this week, control changed hands. Silver did not break below $65. Pressure failed. The weekly close held. That means the structure held. And when structure holds at moments like this, it sends a clear message. The market is no longer asking permission. It has already chosen a direction. This is not speculation anymore. It is confirmation. The banks tried to force the price lower and failed. Sellers showed up and were absorbed. Silence replaced volatility. And that silence was the signal. It told us that supply is tight, demand is patient, and pressure is building instead of releasing. That is the conclusion. From here, the question is no longer if silver moves higher. The question is how fast, how violently, and who gets shaken out along the way. Because once a market survives this kind of test, it doesn't drift sideways forever. It resolves. And resolution never feels comfortable. If you're watching this now, understand this clearly. The most important decision was not made today. It was made earlier, during the boredom, the doubt, and the silence. What comes next will reward preparation, not reaction. This chapter is closed, but the story is not over. In the next videos, we're going to break down exactly what happens after a structural close like this. How price behaves in the first few sessions, where traps usually form, where most people panic, and how moves like this historically unfold when momentum takes over. If you want to understand what happens after control shifts, you'll want to stay with this series, because the quiet part is ending, and the next phase is where things get very interesting.